All right, everybody, welcome back. Last time we did a video on the why behind Code 3 assets, took a little deeper dive on that. If you remember, that was the video with bullseye target with the why in the center. I think it's pretty important to start with the why in anything you're doing in life. So we took a little deeper dive on that, and now we're going to move into the how. So if you haven't seen the why video, just send us an email, community@code3assets.com. Say you'd like to see the why video, put that in the subject line, and we'll get that sent over to you. So you should be able to see the screen now. On this particular video, we're going to go a little deeper into explore the how we're going to use syndications, and that's going to be by understanding them. So kind of on the, just like you've seen on the last video, if you're wondering why you're seeing an operational briefing or a mission brief or tactics, techniques, procedures, how any of this has to do with investing, just send an email at swat@code3assets.com, and we'll send you a series of 3 reports. One is lessons learned from my SWAT and tactical experience, and then one is offensive and defensive strategies you can use in your business and investing careers and even life. So that's something that we've years ago pulled over from that training and experience and tried to apply that in our life where applicable. So if you're kind of curious how that all ties again, just send the email to swat@code3assets.com and you'll get all 3 of those reports. They're totally free, so you might find them to be an interesting read. As you'll see in those reports, you'll see everything in the tactical world is made up of tactics, techniques, and procedures. The tactic is whatever we're trying to accomplish. The technique is how in which we're trying to accomplish it. And a procedure is something that enhances the technique, makes everything work a little better, a little easier, just accelerates the technique, which therefore accomplishes the tactic. And again, send an email to swat@code3assets.com. You'll get those 3 reports, and it'll go into that quite a bit further. And it'll have actually comparison contrast between business and investing, and then various tactics, techniques, and procedures used in SWAT operations. So if nothing else, might be kind of an interesting read for you. So again, we're going to focus on the how. This is going to be part 1 of a 2-part video series to keep them short enough that it doesn't take too much of your time at any one sitting. So look at Black's Law Dictionary, how they define a syndication. I just simplify that and say it's a group of people coming together to accomplish some financial interest that's of mutual benefit. So little disclaimer, you'll notice at the bottom, be on all the slides, we're not tax professionals, we're not legal professionals, we have access to them, and you should really consult with tax or legal counsel before you make any investment. I don't care if it's the stock market or syndication or something in your own account. You should always build a team of professionals that can advise you well. If you don't have that or you need that, just send an email to team@code3assets.com and let them know that you would like to have a referral to maybe a CPA or a legal a lawyer or something like that. And we could certainly send something your way and you can determine if that's a good fit for you. So we're going to go through an example of how a syndication may be used, some pros, cons, so forth. And then on the next video, we'll have a diagrammatic sketch that breaks down just kind of the overall structure of a syndication so people can get their head around it. We'll explain it and you'll have kind of a visual there because what we found is a number of people don't know what syndication really means. That's the whole point of these video series. So an individual could buy one house or one fourplex or 2 houses in their own account, and they could choose to put them in one LLC or 2 LLCs or some form of entity, or they could choose to put them in no entity. That might not be the best move, but you'd want to consult your legal counsel on that. But for this example, as you can see, let's just say there's $500,000 deployed and into these properties, whether that's 2 $250,000 houses or 1 fourplex at $500,000. Let's just say we're getting a cash on cash return of 8% on our 500. That's about $40,000 a year. One market would be of effect if there was 1 property, or maybe up to 2 markets if there were 2. You'll notice the economies of scale. We're really not going to have much economy of scale, whether it's in a syndication or your own account if you have a small volume like that. And then the vacancy is obviously self-explanatory. If you have 1 house and somebody moves out for whatever that period of time is, you're 100% vacant. If you have 2 properties, you may be 50% vacant. Maybe if it's a fourplex, you're 25% vacant. But just making an illustration there, not saying one is right or wrong. None of this is to say one model is better than the other. It's just to get you to understand some of the pros and cons of the different models. So we're certainly not saying don't go buy any property in your own account. That would be awesome to do. So just some comparison and contrast here. Same investor could say buy a 12-unit apartment building and put it in one legal entity, such as an LLC. Again, $500,000. So this time we're going from all cash paid just to show a different angle. And let's say you put 20% down, you got a $2.5 million asset then, and you got 12 doors under one roof. Let's say we're still getting the 8% cash on cash return. So that's still a $40,000 annualized return. And we're still looking at the effects of one market, whether that's the employment base goes up or down, or whatever may happen in that market. We're exposed to just the one market, maybe getting a little more economy of scale, but probably not enough to be truly passive to where you don't have to do any maintenance or do any management or kind of keep your thumb on those things. And then just for a mathematical comparison, if one tenant moved out, assuming it was 100% occupied, you'd have about an 8.3% vacancy. So you can kind of start to see the exposure to that goes down a bit if one was to choose this model. Again, not right or wrong. On the syndication side, you could have the same investor and they could acquire a portion of 5 properties in a limited partnership. So let's say that same investor is still wanting to deploy the same $500,000 into some assets. They could do that by dividing it across 5 assets, and they could choose to hold those in one or up to 5 different entities. So you'll see here 5 different syndications. We still got the 500 deployed, still getting that 40,000 a year on the 8% cash on cash, but we're exposed to 1 or 5 or up to 5 different markets, assuming those are divided across 5 markets. So one market could have some negative effect and the other 4 wouldn't even be affected, because real estate in this example is just real estate, but it could be any asset classes under this example. But real estate is very market to market. So is anything else. So if one tenant moved out in something like this, and you were part of a large scale syndication, you'd have a very minimal effect on the vacancy percentage. So again, we're using real estate because it's easy for people's mind to go there, but this could be oil, gas, ATM machines. It could be a number of things, any real asset. So let's talk about what could happen if something bad showed up. Well, if you had, say you have an internal lawsuit, a tenant sues you for something that happens inside the building or a natural disaster. If you own one unit in one place or one building in one place, you could be up to 100% loss or some portion thereof. If you had in the other model, you could be a 50 to a 100% loss, depending on what happened. If you had both those buildings inside of one LLC and somebody sued you inside of that LLC, you could have 100% exposure there. Or if you had 2 buildings side by side and a tornado came through, you could have all exposure there. A number of things, but so you could be 50 to 100% exposed depending on how you had that divided up and structured. Say the same thing happened and you had that same $500,000 deployed over 5 different syndications. You own a small percentage of each syndication. Therefore, your risk in any one envelope is, smaller. So here you could maybe have up to a 20% loss if one of those 5 things suffered a terrible event that caused a complete loss. So again, just an example of real estate, but here's a number of other things that that you could do the same model with. So we're not saying one is better than the other, just illustrating that one investor could make 3 different choices here and have 3 different cause and effect relationships as it's related to the simplified example here on the screen. So that's kind of what a syndication is. A group of people come together and divide the pie up, which then divides the gains, divide the risk, and so forth. Couple rules with syndications. Basically, if you're making a return that's completely passive, it's 100% reliant on somebody else's efforts, then you're talking about a security, and you either need to register that security or you're going to have an exemption. 2 exemptions that are commonly used here, a 506B and a 506C. And under a 506B, this is important, I think, for people to understand. It's not out in the weeds. This is going to illustrate why you may or may not want to behave a certain way moving forward. But under a 506B, the couple key points is we could take up to 35 non-accredited investors, and I'm going to explain what accredited investor means here in just a moment. So that's pretty cool for people that aren't accredited but have investable resources and can, are sophisticated enough to be able to analyze a deal and see if it makes sense for them. But we cannot advertise, so that makes it kind of a downside to the syndicator. Is they're a little bit tougher to put together. We have to be a little bit more cautious in how we can't advertise and those sorts of things. So from a marketing perspective, that's one reason syndicator may not like it. Under 506C, you can see that we can only take accredited investors, but we can advertise. So we do not require a pre-existing relationship with the potential investor. Therefore, we can advertise. On the other side, we need a pre-existing substantial relationship with someone for them to be able to invest. And that relationship would have to happen, or would have to exist, before the deal was presented to someone. So we can't come develop a relationship with you and say, hey, John, let's develop this relationship and here's this deal. We can't do that simultaneously. We have to have a pre-existing relationship with someone. In other words, somebody knows, likes, and trusts you, and then you can invest as a non-accredited individual. So what's an accredited investor? It can be done a number of ways, but the most simplified and most commonly applied way is you got to have a net worth of $1 million at the time of investment, excluding the value of your primary residence, or as a single person, $200,000 in income annually for the 2 most recent years, or married, that number is $300,000 if joint, and a reasonable expectation that you're going to achieve that income in the coming year. There are some other situations not listed here, but they're a little more complex. These are the most common. So why would you want to join communities, whether it's the Code 3 Assets community or any other community, especially if you're a non-accredited investor? Well, we can't advertise. We already told you that, and we need a pre-existing relationship for you to be able to participate in deals. So over time, you want to cultivate those relationships and get sophisticated and do things like this where you can understand how they operate so that you can make good decisions. You can develop teams, you can get referrals for legal and tax teams, and be in a position to where if an opportunity were to arise that made sense for you, you would have already done the early steps necessary to be in a position to participate. If you didn't, and you can notice, then if it was a 506B and you didn't have that relationship, you wouldn't be able to participate. Or if it was a C, it would be accredited only. So you either have to become accredited or develop those relationships to be able to participate in these private placements. So just wanted to illustrate that. So what can you do with that? Well, you can join our community and you can start that, start participating in some meetups, start getting more sophisticated through information that we distribute and information we share from people in our network that they are creating. Just send an email to community@code3assets.com, as noted on the left there in the center. And again, if you want to see how some of the SWOT and tactical principles that I've been fortunate to experience in my life, how we apply some of those, you can send that email to SWOT@code3assets.com, and you will get those 3 free reports, no obligation there. So ask yourself, what's important now? That's one thing you'll see in those SWOT reports that you always want to ask yourself as you're facing decisions in life. When we deal with major critical incidents and you're wondering, oh my goodness, how do we deal with this giant elephant? How do we eat this thing all at one time? Well, we don't. We break it down to bite-sized pieces and we consistently ask what's important now. And we answer that based on some predetermined decision-making matrices, which will be listed in those reports. So again, send an email to SWOT@code3assets.com. Get the reports if you don't have them. They're kind of an interesting read. And if you want to join the community and get more information like this and get plugged into potential meetups in the future, Zoom meetings and so forth, just send an email to community@code3assets.com. So with that, appreciate everybody watching, and we'll see you on part 2 with the next video there.